Most people who quit trading don't quit loudly. There is no dramatic final loss, no single trade that ends everything. What usually happens is far quieter. The screens get opened less often. Journals stop being updated. Trades are taken sporadically, without conviction. Eventually, trading becomes something they talk about in the past tense. I tried it for a while. It wasn't for me. The market is too manipulated. What's dangerous about this kind of quitting is that it feels rational. It feels like a logical conclusion after months or years of effort that didn't produce the desired results. But beneath that rational story is a deeper truth that most traders never fully face. They didn't fail because they weren't smart enough, disciplined enough, or talented enough. They failed because they never developed the one habit that allows a trader to stay psychologically intact long enough for any edge to compound. This habit has nothing to do with strategy selection, market timing, or risk formulas. It has nothing to do with indicators, sessions, or instruments. And it doesn't show up on a P&L statement in any obvious way. Yet it quietly determines who survives the long, grinding middle phase of trading and who slowly bleeds out emotionally before consistency ever has a chance to appear. In the beginning, survivors and quitters look exactly the same. They both start with excitement and curiosity. They both feel a sense of possibility when they first realize trading is a skill, not a lottery. They both dive into learning. Charts become familiar. Terminology starts to make sense. Patterns begin to repeat. There's a moment, almost universal, where it feels like the puzzle is coming together, where losses feel temporary and success feels inevitable. Then reality introduces itself. Losses start clustering. Drawdowns feel heavier than expected. Strategies that looked perfect in hindsight behave unpredictably in real time. Emotions appear that weren't present in backtesting or demo trading. Fear, hesitation, overconfidence, frustration, not as abstract concepts, but as physical sensations that interfere with execution. This is where the first invisible split occurs. Quitters experience these moments as evidence that something is wrong with trading itself. Survivors experience them as evidence that something is being revealed. That difference sounds small, but it's not. It changes how every setback is processed. A quitter looks at a losing streak and asks, "Why isn't this working?" A survivor looks at the same streak and asks, "What is this showing me about how I behave under pressure?" One question pushes responsibility outward. The other pulls awareness inward. Over time, those directions lead to completely different outcomes. The habit that separates survivors from quitters is not emotional control. It's emotional observation. Survivors develop the ability to notice what they do under stress without immediately trying to change it, justify it, or escape it. They watch themselves the way a scientist watches an experiment, not with judgment, but with curiosity. This sounds passive, almost detached, but it's one of the hardest skills a human being can develop, because it requires sitting with discomfort without trying to eliminate it. Quitters, on the other hand, react. When something feels wrong, they change something. New rules, new confirmations, new strategies, new time frames, new mentors, new beliefs. Their trading becomes a constant attempt to outrun discomfort, and in doing so, they never allow clarity to form. Most traders believe progress comes from improvement. Survivors learn that progress often comes from stability. When a trader changes too many variables at once, they erase cause and effect. They don't know whether results came from the strategy, the market condition, or their behavior. Over time, this creates a sense of randomness, and randomness destroys confidence. If nothing feels repeatable, nothing feels worth committing to. Survivors tolerate this uncertainty long enough to see patterns emerge, not just in the market, but in themselves. They begin to notice things like, "I hesitate more after a win than after a loss. I overtrade when I'm bored, not when setups are good. I break rules most often when I'm trying to avoid being wrong. I increase size when I feel confident, not when probabilities improve." These observations don't come from analysis. They come from stillness, from not reacting immediately, from allowing behavior to reveal itself without interference. Quitters rarely reach this level of clarity because they don't stay still long enough. The discomfort of seeing their own patterns feels worse than the discomfort of starting over, so they reset, again and again. Each reset feels like hope, but it actually delays growth. There's a psychological reason for this. When a trader admits that their biggest obstacle is their own reaction to uncertainty, they lose a comforting illusion that the solution is external. External problems have external fixes. Internal problems require internal responsibility, and responsibility is heavy. Quitters resist it until exhaustion forces them out. Survivors accept that weight early. Another critical difference appears in how losses are interpreted. Quitters experience losses as verdicts. Each loss feels like a judgment on their ability, intelligence, or potential. Even when they say they understand probabilities, emotionally they still expect good behavior to produce good outcomes immediately. When that expectation isn't met, self-doubt grows. Trading begins to feel personal. Survivors experience losses as data. Not cold, emotionless data. Losses still hurt, but information nonetheless. A loss is not proof of failure. It's proof of participation. Over time, survivors internalize a truth that quitters never fully accept. Good decisions can lead to bad outcomes, and bad decisions can occasionally lead to good ones. Once this is deeply understood, outcomes lose some of their emotional authority. This doesn't make survivors numb. It makes them stable. Stability is what allows a trader to stay engaged through drawdowns without self-destructing. It's what allows them to continue executing the plan when confidence is low. It's what allows learning to compound instead of resetting. One of the most misunderstood ideas in trading is discipline. Most people think discipline means forcing yourself to do the right thing. Survivors learn that real discipline is non-interference. It's the ability to not act when every impulse is screaming to do something. This kind of discipline is impossible without awareness. You can't resist what you don't notice. Quitters try to suppress emotion. Survivors acknowledge it. When fear appears, a quitter asks, "How do I get rid of this?" A survivor asks, "What is this fear trying to push me to do?" That question alone creates distance, and distance creates choice. This habit shows up most clearly during drawdowns. Drawdowns are where most traders quit, not because of the money lost, but because of the psychological erosion. Confidence fades, doubt grows, the urge to change everything becomes overwhelming. Quitters respond to drawdowns by searching for escape. Survivors respond by narrowing their focus. They trade smaller. They simplify. They observe more carefully. They don't rush to fix what they don't yet understand. This patience is not passive. It's deliberate. Survivors know that their primary job during difficult periods is not to make money, but to avoid psychological damage. They protect their ability to continue. Quitters sacrifice that ability in an attempt to recover faster. There is also an identity component that quietly pushes traders out. Many quitters tie their self-worth to trading outcomes without realizing it. Wins make them feel capable. Losses make them feel inadequate. Over time, this emotional dependence becomes unbearable. Trading stops being a skill to develop and becomes a measure of personal value. At that point, quitting feels like relief. Survivors separate who they are from what they do. They take responsibility without self-attack. This separation allows them to face mistakes honestly without collapsing under them. It allows learning to continue instead of turning inward as shame. The habit of observation protects identity. It allows mistakes to exist without defining the person. This is why survivors don't rush to label themselves. They don't call themselves profitable too early. They don't call themselves failures too quickly either. They remain in a developmental mindset long after others demand certainty. What most quitters never realize is that trading doesn't eliminate uncertainty. It exposes your relationship with it. The market becomes a mirror. If you need certainty to feel safe, trading will punish you. If you need validation to feel competent, trading will exhaust you. Survivors don't escape these needs immediately, but they see them clearly, and seeing them is the first step to loosening their grip. By the end of this first phase, survivors and quitters have lived through similar experiences. The difference is not what happened to them, but how they related to it. One avoided discomfort by changing external conditions. The other stayed present long enough for internal patterns to become visible. That visibility is the foundation of everything that follows. As traders move beyond the early excitement and into the long middle phase, something subtle begins to happen. The market stops feeling like an opportunity and starts feeling like a test. Not a test of knowledge, but a test of endurance. Every loss carries more weight, not because it's larger, but because it lands on top of previous disappointments. What once felt like temporary setbacks start to feel like evidence. Evidence that maybe this isn't going to work. Evidence that maybe they're not built for this after all. This is where emotional fatigue sets in. And emotional fatigue is one of the most underestimated forces in trading. It doesn't arrive dramatically. It creeps in slowly. It shows up as hesitation where there used to be confidence, as indifference where there used to be curiosity, as frustration where there used to be patience. Traders don't quit because they can't trade. They quit because they get tired of feeling conflicted all the time. Survivors recognize this phase for what it is. Quitters mistake it for failure. The difference lies in how losses are processed internally. On the surface, everyone experiences drawdowns, but psychologically, there are two very different interpretations happening beneath the same numbers. Quitters experience losses as personal. Survivors experience them as situational. When a quitter takes a loss, the mind doesn't stop at, "This trade didn't work." It continues to, "Maybe I don't know what I'm doing. Maybe I'm wasting my time. Maybe I'm not disciplined enough. Maybe I'm just not one of the few who can do this." Over time, losses stop being about money and start being about identity. The market becomes a constant source of self-evaluation, and no one can withstand that indefinitely. Survivors feel the emotional impact of losses too, but the story doesn't go as far. A loss is frustrating, disappointing, sometimes even painful, but it doesn't become a verdict. This is not because survivors are more confident by default. It's because the habit of observation creates a buffer. They notice the emotional reaction without immediately believing the story attached to it. That buffer is everything. Without it, emotions turn into conclusions. With it, emotions remain experiences. One passes, the other defines. This is why many traders intellectually understand probabilities but emotionally react as if every trade is a judgment. The mind knows losses are part of the game, but the nervous system experiences them as threats. Survivors don't try to eliminate that threat response. They let it exist without letting it steer behavior. Quitters, on the other hand, try to escape it. They reduce discomfort by changing something external. New strategies provide temporary relief, not because they are better, but because they restore hope. Hope is powerful, but it's also fragile. Each time hope collapses, the emotional cost increases. Eventually, there's nothing left to prop it up. One of the clearest signs a trader is drifting toward quitting is impatience with process. They want answers quickly. They want confirmation. They want to know if this is going to work before they commit fully. Survivors commit first and look for confirmation later. Not blindly, but deliberately. They understand that evidence only becomes reliable over time, and time only passes if you stay consistent. This patience is often mistaken for confidence. In reality, it's tolerance. Tolerance for uncertainty, tolerance for ambiguity, tolerance for discomfort. Survivors don't wait to feel ready. They learn to function while feeling unsure. This is where many traders misinterpret fear. They believe fear is a sign they're doing something wrong. Survivors learn that fear is a sign they're doing something meaningful. Growth rarely feels safe. Every trade is a small act of uncertainty. Trading exposes this brutally. Every drawdown is a test of emotional regulation. Quitters respond to fear by trying to eliminate it. Survivors respond by making it familiar. Familiarity changes everything. The first time you sit through a losing streak, it feels unbearable. The second time, it's uncomfortable. The third time, it's manageable. Not because it hurts less, but because you've learned you can survive it. This learning doesn't happen if you exit the experience early. You have to stay in it long enough for your nervous system to recalibrate. This is why survivors often reduce size during difficult periods instead of stopping altogether. They protect their ability to stay engaged. Quitters often do the opposite. They increase risk in an attempt to recover faster. This accelerates emotional exhaustion and shortens their time horizon. Time horizon is another silent divider. Quitters operate on short horizons. They measure progress in days or weeks. Survivors think in months and years. This doesn't mean they're complacent. It means they understand that skill development doesn't follow a straight line. They allow for plateaus. They allow for regression. They allow for slow progress. One of the most damaging beliefs a trader can hold is that consistency should feel good. It rarely does at first. Consistency feels boring, repetitive, and unrewarding in the short term. Quitters crave stimulation. They want excitement, validation, and emotional payoff. Survivors accept monotony as part of the cost. This acceptance changes how effort is experienced. Quitters feel like they're constantly pushing uphill. Survivors feel like they're laying bricks. Each day doesn't feel meaningful on its own, but over time, structure forms. There's also a subtle shift in how survivors relate to learning. Quitters often treat learning as a way to avoid execution. They study to feel productive without facing risk. Survivors learn to support execution, not replace it. They stop chasing new ideas and start deepening understanding of their own behavior. This shift often coincides with a reduction in consumption. Fewer videos, fewer opinions, less noise. Survivors protect their mental environment. Quitters overload it. Noise creates comparison. Comparison creates doubt. Doubt erodes commitment. Survivors limit comparison because they understand that trading is highly individual. What matters is not whether others are succeeding, but whether they are improving. Improvement for survivors is measured in behavioral metrics. Fewer impulsive trades, fewer rule violations, faster emotional recovery, clearer awareness. Quitters measure improvement in P&L alone. When P&L stagnates, motivation collapses. Another critical difference appears in how survivors handle self-trust. Quitters constantly question themselves. Every loss chips away at confidence. Every mistake feels like proof they can't be trusted. Survivors rebuild self-trust through follow-through, not outcomes. Each time they execute their plan despite discomfort, trust grows. Not in the strategy, but in themselves. This self-trust becomes the stabilizing force that carries them through inevitable setbacks. Without it, trading becomes emotionally draining. With it, trading becomes manageable. By the end of this phase, the gap between survivors and quitters widens. One group is emotionally fatigued, uncertain, and increasingly disengaged. The other is not necessarily profitable yet, but they are grounded. They understand themselves better. They recover faster. They no longer interpret every fluctuation as a verdict. This is the phase where most traders disappear quietly, not because they lack ability, but because they can no longer tolerate the internal conflict. At some point, survivors notice something that feels almost counterintuitive. The harder they try to force results, the worse their trading becomes. Early on, effort felt like the solution. More screen time, more analysis, more journaling, more studying. Effort was equated with progress. But after enough cycles, a pattern emerges. Periods of intense effort often precede the most costly mistakes. Quitters interpret this as proof they aren't disciplined enough. Survivors interpret it as information. This realization marks a critical psychological shift. Survivors begin to separate effort from control. They understand that while effort is required to prepare, execution happens in a different mental state entirely. Trying to control outcomes creates tension. Tension narrows perception. Narrow perception leads to reactive decisions. The market punishes reactivity. This is why survivors start paying attention not just to what they do, but how they feel when they do it. They notice that their worst trades often occur when they are emotionally invested in being right, recovering losses, or proving something to themselves. These motivations don't feel dramatic in the moment. They feel justified, logical even, but the body tells a different story. Shallow breathing, tight shoulders, restless eyes scanning for confirmation. Observation reveals what effort hides. Quitters often double down during these moments. They believe the solution is more discipline, more rules, more constraints. Survivors learn that discipline without awareness is brittle. It breaks under pressure. Awareness creates flexibility. Flexibility allows discipline to adapt instead of collapse. One of the most misunderstood habits of survivors is restraint. It's often mistaken for passivity or fear. In reality, it's deliberate non-action. Survivors become comfortable sitting through boredom, through missed trades, through setups that almost fit but don't quite align. Quitters feel compelled to act. Action feels like control. Inaction feels like falling behind. But trading rewards patience far more than activity. This patience doesn't come from willpower. It comes from clarity. Survivors define their criteria so precisely that deviation becomes obvious. When clarity is high, decision-making is simple. Not easy, but simple. Quitters operate in ambiguity. Ambiguity invites interpretation. Interpretation invites emotion. As survivors refine their process, they also change how they relate to mistakes. Quitters avoid mistakes emotionally. They rationalize them, minimize them, or beat themselves up for them. Survivors examine mistakes without judgment, not because they are emotionally detached, but because they understand that judgment distorts feedback. Every mistake contains data, but only if the ego doesn't interfere. Survivors treat mistakes as signals pointing to psychological patterns rather than technical flaws. A late entry isn't just a timing issue, it's often a fear of missing out issue. An early exit isn't just risk management, it's often discomfort with uncertainty. Overtrading isn't a strategy problem, it's often an emotional regulation problem. Seeing this takes courage. It's easier to blame the strategy than to confront personal patterns. This is where the one habit truly begins to crystallize. Survivors consistently return attention inward. Not obsessively, not emotionally, but neutrally. They watch their thoughts. They notice urges. They observe impulses without immediately acting on them. This habit doesn't eliminate emotions. It creates space around them. That space changes everything. Within it, survivors learn to respond instead of react. They don't suppress emotions. They allow them to rise and fall without hijacking behavior. Quitters feel emotions as commands. Survivors feel them as information. This distinction is subtle but decisive. Over time, survivors also redefine what success feels like. Early on, success was winning trades. Later, it becomes following the plan. Eventually, it becomes maintaining internal stability regardless of outcome. This doesn't mean profits no longer matter. It means profits stop being the sole source of validation. This internal shift reduces pressure. Reduced pressure improves execution. Improved execution leads to consistency. Consistency eventually leads to profitability. The sequence cannot be reversed. Quitters attempt to shortcut this process. They want profitability first, hoping confidence and discipline will follow. Survivors accept that confidence is built through repeated exposure to discomfort handled well. This acceptance allows survivors to endure periods of stagnation without panic. They understand that plateaus are part of skill acquisition. Progress happens in bursts separated by long stretches of apparent stillness. Quitters interpret stillness as failure. Survivors interpret it as integration. Integration is invisible from the outside. Nothing changes in results for a while, but internally, reactions soften. Decisions feel less charged. Losses sting less. Wins excite less. Emotional volatility decreases. This emotional leveling is often mistaken for apathy. It's not. It's maturity. As this maturity develops, survivors naturally trade less, not because they are afraid, but because they no longer feel compelled to be constantly involved. They wait for clarity. They wait for alignment. Quitters fill silence with activity. Survivors protect silence. Silence is where awareness grows. Another important transformation occurs in how survivors relate to external validation. Early on, traders seek confirmation from others, signals, opinions, community sentiment. Survivors gradually withdraw from this, not in isolation, but in independence. They learn to trust their process. This trust doesn't come from blind belief, but from repeated evidence of self-control. Each time a survivor follows their rules in a difficult moment, trust deepens. Each time they walk away from a tempting but invalid setup, trust grows. Each time they accept a loss without spiraling, trust solidifies. Quitters undermine trust every time they break their rules. Over time, they stop believing themselves. Once self-trust erodes, trading becomes impossible. Survivors understand this intuitively. They protect self-trust as a non-negotiable asset. This is why survivors often appear calm even during drawdowns. It's not because they don't care. It's because their identity is no longer entangled with short-term outcomes. They see themselves as process-driven individuals operating in a probabilistic environment. Quitters see themselves as performers being judged by the market. The market is a brutal judge if you seek approval from it. Survivors stop asking, "What does this trade say about me?" They ask, "Did I execute according to plan?" This reframing removes emotional charge. It shifts focus from ego to behavior. By now, the habit of observation is no longer something survivors consciously practice. It becomes automatic. Thoughts are noticed. Emotions are felt. Impulses are recognized. Action is chosen deliberately. This doesn't mean mistakes disappear. They don't. But mistakes become smaller, less frequent, and less destructive. Recovery becomes faster. Perspective returns quicker. The emotional aftershock shortens. Quitters, by contrast, experience compounding damage. Each mistake increases frustration. Frustration leads to more mistakes. The spiral tightens until quitting feels like relief. Survivors never reach a point where trading becomes effortless, but it becomes sustainable. And sustainability is what separates those who remain from those who leave. By the time a trader reaches this stage, something fundamental has changed. The market no longer feels like an adversary or a puzzle that needs to be conquered. It feels neutral, impersonal, almost indifferent. This neutrality is not discouraging. It's freeing. Survivors stop trying to extract meaning from every tick. They stop searching for reassurance in short-term outcomes. They understand that the market doesn't respond to effort, intention, or emotion. It responds only to order flow, liquidity, and probability. Quitters never quite make peace with this. They continue to believe that if they just try harder, learn more, or find the right insight, the market will finally cooperate. Survivors accept that cooperation was never part of the deal. This acceptance removes a massive psychological burden. Trading stops being a negotiation with reality and becomes an interaction within it. Survivors don't demand outcomes. They participate in a process. They show up prepared. They execute when conditions align. They step aside when they don't. The habit that separates them from quitters is now fully integrated, sustained self-observation without interference. It sounds simple. It isn't. Most people cannot watch their own mind without trying to change it. They react to reactions. They judge emotions. They fight impulses. Survivors learn to let internal experiences exist without giving them authority. Fear can be present without dictating behavior. Desire can arise without being obeyed. Frustration can appear without leading to revenge trading. This ability doesn't eliminate emotional pain. Losses still hurt. Drawdowns still test confidence. But the pain no longer metastasizes into identity damage. Survivors feel disappointment without turning it into self-condemnation. Quitters never develop this separation. Emotion and action remain fused. When they feel urgency, they act urgently. When they feel fear, they exit early. When they feel anger, they overtrade. Over time, this fusion exhausts them. Trading becomes emotionally expensive. Quitting becomes an act of self-preservation. Survivors, on the other hand, lower the emotional cost of participation. They don't rely on motivation. Motivation fluctuates. They rely on structure. Structure doesn't require enthusiasm. It only requires follow-through. This is why survivors don't talk much about passion for trading. Passion fades. Habits remain. As the years pass, survivors also realize that the market never becomes easier. What changes is their relationship with it. They no longer interpret uncertainty as danger. They see it as the medium in which opportunity exists. Without uncertainty, there would be no edge. Quitters crave certainty. They want confirmation before risk. Survivors understand that confirmation only comes after risk is taken. This understanding alters their time perspective completely. Survivors stop evaluating themselves on a trade-by-trade basis. They evaluate themselves over hundreds of trades, over thousands. They think in distributions, not events. This long view softens emotional reactions and stabilizes behavior. It also changes how they experience winning. Wins no longer produce euphoria. Euphoria leads to overconfidence, which leads to mistakes. Survivors enjoy wins quietly. They acknowledge them, log them, and move on. The emotional peak is intentionally kept low. The same applies to losses. They're acknowledged, reviewed, and released. No spiraling, no dramatizing, no story-making. This emotional moderation is not suppression, it's regulation. Survivors regulate themselves the way professionals in any high-performance field do. Surgeons don't celebrate every successful operation. Pilots don't panic during turbulence. Elite performers normalize pressure. Trading is no different. One of the final transformations survivors experience is detachment from outcome-based identity. They no longer see themselves as winning traders or losing traders. They see themselves as operators of a system. Some periods favor their system, some don't. Their worth is not tied to either. This detachment is often misunderstood as lack of ambition. In reality, it's the foundation of longevity. Survivors stay in the game long enough for probabilities to work in their favor because they don't burn themselves out chasing validation. Quitters often leave with bitterness. They conclude that trading is a scam, that the market is manipulated, that success is reserved for insiders. These stories protect the ego but prevent growth. Survivors don't need these narratives. They've seen enough cycles to know that consistency is rare but real. They also understand that most traders fail not because they lack intelligence, but because they never adopt the one habit that makes everything else possible. They never learn to observe themselves honestly and continuously. Without this habit, strategies become weapons turned inward. Rules become sources of guilt. Losses become evidence of inadequacy. With this habit, strategies become tools, rules become anchors, and losses become feedback. This is why survivors often look unimpressive from the outside. No flashy gains, no dramatic stories, no constant excitement, just quiet, steady participation. They outlast. The final irony is that many quitters were technically capable of success. They had the knowledge. They had access to information. They had tools and resources. What they didn't develop was tolerance for internal discomfort. They tried to think their way through an emotional problem. Survivors did the opposite. They stopped trying to eliminate discomfort and learned to coexist with it. That is the one trading habit that separates survivors from quitters. It's not strategy selection. It's not risk-reward ratios. It's not indicators or market structure. It's the ability to stay present with uncertainty, to watch the mind without obeying it, and to continue executing a process long after novelty has faded. Trading doesn't reward brilliance. It rewards stability. Those who survive are not the most talented, the most confident, or the most aggressive. They are the ones who remain emotionally available to the process long enough for skill to compound. Everyone else leaves. Some loudly, some quietly, some blaming the market, some blaming themselves. Survivors don't need an explanation. They're still there. And that, more than anything else, is what separates them.